what is correlation, right? I just want to get a feel of the number of you in this webinar, in this presentation room. How many of you here knows what correlation is? Okay, not just from a statistical standpoint, but when it comes to analyzing the markets. How many of you here know what correlation is and how it is being used in the markets? Okay, so fantastic. There are some of you are are clear about correlation. Some of you not so. Most of you not so clear. All right, a bit of you have some basic knowledge, scratch the surface knowledge. All right, so what I hope to. Okay, so Scott is saying certain pairs move together either in the same direction or opposite direction. Yeah, generally that's the idea, right? But correlation is a lot more than that, right? Economists use it, right? Traders use it as well, and it's also important, right, to use it to get a sense of the market risk sentiment for the day. Okay, so I'm going to dive a bit deeply over this short period that I have to try to cover as clearly as possible what correlation is and how we use it in the markets. So the basic understanding of correlation is that correlation is really a statistical concept that is used to measure the degree or magnitude of move between different variables. Now, for those of you who took basic statistics, right? For those of you who took economics, okay, understand that there are two variables when it comes to correlation, right? One, we use the letter R, small letter R, when we are looking at just two variables, when we're comparing two variables, right? When we're looking at multiple variables, so when we're comparing a group of people with with one another, right, that requires ranking of correlation, we use the Greek alphabet rho, right? That it looks like a P, but it's actually rho, RHO, right? It's pronounced, it's spelled as RHO. When we're talking about correlation, the measure we talk about correlation as a statistical concept, but when we calculate correlation, it is known as a correlation coefficient. And correlation coefficient takes a value only from -1 to a +1. All right, so this is important for you guys to note. A -1 to a +1, that is a correlation coefficient value. Now, what this means is that for a correlation value of -1, it means that the variables are perfectly negatively correlated. So an example will be, let's say that we're looking at the S&P, okay, the S&P 500, the US stock index, and we're looking at the price of gold. Okay, so traditionally they are negatively correlated. What this means is that if S&P moves up, you should generally see the price of gold drop. Okay, and if they are perfectly negatively correlated, it means that every 1%, or let's make the numbers a bit bigger, okay, every 10% move up in the S&P, you will see a similar 10% drop in the price of gold, right? That means they are perfectly negatively correlated. The opposite is true, right? Correlation value of a +1 means that they are perfectly positively correlated. Okay, so an example will be the price of oil and the Canadian dollar, right? So one of you actually pointed that out in the example earlier, right? Singhua, yeah, you're definitely paying attention, right? You guys said it's something like crude oil and Canadian loonie, right? So it's really nice to know that you guys are listening and paying attention and applying it on your end as well. Give me a moment. Some of you are again repeating that there is no sound, right? I'm always worried that the sound is dropping. Okay, so oil and Canadian loonie are perfect example. Okay, in a perfect world, they are perfectly positively correlated. So they have a correlation coefficient value of +1. What this means is that a 10% rise in oil prices will see a similar 10% rise in the Canadian dollar. Okay. Now, Chun Kiet, you're asking that S&P and gold always have always have negative correlation. In short, no, they do not. Okay, real life, we don't always see that the correlation will always stay the same, right? In real life, correlation actually fluctuates between -1 to +1. In fact, in real life, we hardly even see perfect negative correlation or perfect positive correlation. It's always somewhere in between, right? But theoretically speaking, if you guys have gone through business schools, if you guys have gone through finance courses, right, you always hear this thing about correlation and saying that, okay, if the S&P goes up, gold goes down, because S&P is a risk on asset class, right? When people are willing to take on more risk, they start moving money into the stocks, all right, in the stocks asset class, and therefore they take money out of a safe haven like gold and they put it in stocks, right? So they sell stocks. That is why there's that negative correlation. Okay, that is why there's that negative correlation. All right, so Narisha, you're asking what's the correlation between MPLET's share price and platinum. Okay, so I will get to that in a while, right? I'll show you guys. Some of you, Queen, you're also asking how to know if they're correlated and where to find it. There is a very quick way, actually, on TradingView, how to do this correlation. It's like sort of a cheat sheet, which I will share with you guys later. But in order to understand, you need to have the fundamental concept, right? You need to have the basic understanding of how correlation works. All right, so I just want to be sure that you guys are clear about what correlation is, and that correlation can only take a value between -1 to a +1. All right. So the next few slides, okay, I'm going to show you guys the different types of correlation. Okay, correlation does not necessarily mean that whether they move together or they move apart, right, or one moves faster and slower. It's not just that, right? There's a very broad way of looking at correlation. Okay, so the first type of correlation that we have is correlation within FX pairs. So an example that I have here is the pound dollar, all right, and the pound yen. Okay, this was taken a bit back, right? I in order to give you guys a good example, okay, I had to do a bit of data fitting, a bit of hindsight bias to show you guys a perfect theoretical example, right? But later when there's time, I will cycle through the charts to show you guys. Okay, so pound dollar, pound yen. Pound dollar is the blue line, pound yen is the orange line. Okay, if you guys, and I use closing price because it's easier to see the movements, right? If it's candlesticks, you guys are going to be confused with all the red, green, red, green, red, green, or whatever color you have, you not. Okay, so over here you can see that they are generally positively correlated. Why? Because they move in the same way, right? In the closing price, they form the same shape. Okay, so we have, starting in March last year, okay, we have the pound dollar, pound yen bottoming out over here, and then after that they push up, small pullback, another continuation up, another pullback, and then after they were riding the trend upwards, where they hit an all-year high in the September period. Okay, after that there was another pullback, all right, and then they made a lower low, okay, towards the end of the year. Right, so you can see that their movements are very similar. They would have a positive correlation, and because their movements and even the places where they spike, right, are so similar, I would say that their correlation is to their positive correlation is to a pretty much high degree, which would possibly fall in the 0.8, 0.9 region. Okay, it will never be a perfect +1 correlation like I mentioned earlier, because if you can see, okay, pound yen actually dropped over here, right, and then it made a small push up. However, pound dollar barely dropped as much, and it made a very sharp bounce. Okay, so you can tell that while they are positively correlated, they are not perfectly positively correlated. All right, I hope you guys got this. So this is the first type of correlation, where within FX pairs, we can use correlation to look within FX pairs. to look at whether they are positively or negatively correlated. Okay, so the next example is one of negative correlation. Okay, so I have over here the dollar CAD against the Aussie dollar, right? If you were to look at the graphs in close, again in line chart, right, you can tell that they are sort of a mirror image of the other. You can actually draw a line across, okay, somewhere in the middle, right? And you can see that they are pretty symmetrical. In fact, quite beautifully symmetrical, right? Which then means that their negative correlation is actually to quite a high degree, right? It should fall around 0.9 or so, okay? So you can see that they are basically mirror image of each other. Another good example of negative correlation would be looking at the dollar index itself and the dollar sing, okay? So that is another image of positive, negative correlation. Okay, so this is an example of negative correlation where when one pair moves up, the other pair moves down. Okay, nearly to the same magnitude as well. So this negative correlation coefficient should be somewhere at a negative 0.9. All right, it's a rough estimate. Okay, so this is negative correlation. Now, moving on, if you guys have any questions about positive and negative correlation, please just ask away. I see some hands that are raised. There is no need to raise hands. Okay, don't hesitate to just ask the questions. Okay, I'm just going to remove the raised hands because it pops up. Okay, fantastic. No more hands raised. Okay, great. Now, another sort of correlation is one that is called across asset classes. All right, so we in the institutions, what they say is they like to look at cross asset correlation, right? They look at cross assets correlation is because they like to find where's the best place to position whenever they do their rebalancing of the portfolios or their trades, right? They like to find the best places to take advantage of these positions. Okay, so cross asset correlations. Now over here in the chart, I'm comparing the movement between the S&P 500, which is the orange line, and the euro dollar, which is the blue line. Now, just a quick quiz. Are they positively or negatively correlated? Okay, so you guys are saying positive. Some are saying negatively correlated. Okay. Interesting. Okay. One of you actually said both. Generally positive. Some said positive but not closely. Slight positive. Okay. I would say they are slightly positively correlated. So I will give a correlation coefficient, okay, of about plus 0.4 or 0.3. Okay, so they are positively correlated. Why? Because if you were to identify the highs and lows, again, this is how we look at correlation. We identify the highs and lows. Okay, let's start from the left, right? At the start, look what happened. They are sort of like a mirror image of one another, right? However, over here, when the S&P went down, the euro dollar went down. So from negative correlation, they became positively correlated. And then after that, the euro dollar started climbing higher. The S&P started climbing higher. So their positive correlation was maintaining. And then what happened? The euro started falling first. Okay? After the euro started falling, the S&P climbed a bit higher, showing that the correlation was a bit more negative. Okay? Then once the S&P started tanking in March, this was due to the corona virus, okay, the outbreak, okay, the S&P started tanking like crazy. The euro dollar actually rose quite sharply for a while, showing that they were very strongly negatively correlated. It was only after that, in the towards the end of May, that the euro dollar started tanking together with the S&P, showing very strong positive correlation, right? And they both bottom out at the end of March, okay, probably at the start of April, and then they showed pretty strong positive correlation, all right, all the way till now. So correlation, yes, Valeriano, I hope I got your name pronounced correct. If it's wrong, please forgive me. Hope you don't take any offense. But yes, you are right. Okay, correlation is not just about the distance. It is really about the movement, right? So how do we identify whether instruments are positive or negatively correlated? Would be to identify, okay, put them in the same time frame and then identify the highs and the lows and look for these key levels together, right? And then after that, you slowly trace to see whether they are positively or negatively correlated. So this simple exercise, right? Generally, most of you are, I would say, correct when you say that they are positively correlated, but they are not. Euro dollar and the SPX is not entirely positively correlated. As you have seen, it swings from negative to positive, back to negative, back to positive. But it tends to be more positive than negative. All right, so this is how we can look across asset classes. All right, this is how we can actually look across asset classes. All right, I'll give you guys another example. Okay, so this is a bit more recent, right? This is comparing between the S&P, the blue line, right, and gold. Okay, gold prices, the orange line. Okay, so remember at the start of my presentation, I mentioned that gold and S&P are theoretically supposed to be negatively correlated, right? When S&P goes up, it's because the market is more risk loving. Okay, they become risk takers. They take on more risk. They tend to sell off their safe havens like gold so that they can start putting more money into the stock index, right? But based on this chart here, okay, it's pretty recent. You guys can see that this is really taken from 2020 to 2021. Okay, can you guys tell me whether S&P and gold are positively or negatively correlated? Okay, so we got quite a bit of numbers coming in. All right, this is a bit this will be a bit tricky. Okay, this will be a bit tricky because, like I said, I have a bit of hindsight bias. I purposely picked, okay, a period where it would be a bit confusing. Okay, so yes, I see some answers. Roxanne Scott, fantastic, positive at first and then became negative, right? So yeah, it was initially positive, and then after that, as we turn into 2021, that was when the correlation between S&P and gold started to go back to their theoretical state, which is negative correlation. But generally, for majority of 2020, right, gold and S&P were positively correlated. So 2020, okay, they were positively correlated. I won't go into the estimation of how positively correlated, all right, and then at the turn of 2021, all right, they are starting to go back. They're starting to revert back to their original state. All right, so one of you, Hopet, I hope I got your name right. What do you mean by how does it happen? As in, how does correlation happen? Or okay, before while you're explaining your question, okay, I will move on. All right, so we can see that there is a change in correlation, right? So now, ever since, okay, so at the start of 2021, they were negatively correlated, okay, until recently in April, right, at the start of this month, both strengthened. Okay, there is a reason for this. Okay, there is a reason for why both of them strengthened. Okay, why they strengthened is because the US dollar became extremely weak. Okay, the US dollar became extremely weak, making gold, which is normally denominated in USD, okay, becoming more attractive, right? So people tend, because the price of gold has fallen, or rather, the dollar has fallen. So gold that is denominated in the dollar becomes cheaper, more attractive to buy, right? So they start buying up more of gold, okay? And because you start buying up more of gold, gold prices tends to go up. And because the US dollar has weakened, it's not very attractive to hold onto US dollar. That is why people start putting their money into a different asset class which can generate higher returns. That is in the S&P, in the stock markets. All right, so that is why suddenly at the start of April, you start seeing the correlation becoming positively correlated as well. Okay, Chunwa, you're asking how do we identify the change of correlation? Unfortunately, to identify the change of correlation is not something that you can immediately snipe, immediately pick it up. All right, it takes time to develop. Right, as you go down into the lower time frame, the correlation will be a bit out of whack. Correlation only works slightly better on the higher time frame. All right. So I cannot tell you when we can identify the change in correlation, but when we line the charts up together, okay, and I'll show you guys on TradingView how to generally quickly identify it, but it's not the most accurate way, okay, then you will be able to see it clearer. All right. So I hope understanding this cross asset correlation would really help you when you are trading. Let's say I'm sure some of you are trading or investing in stocks, right? Probably forex. Okay, so you guys will be able to see how as well. Okay, so Chunwa, you're asking what's the best time frame to determine correlation? Okay, for me, right, the best time frame to determine correlation is generally on the 4-hour, the daily, and the weekly. All right, the 4-hour, the daily, and the weekly. I'm just going to write it down here. Okay, the H4. For me personally, I find that when there's less noise in the market, correlation works best. Okay, less choppy movement. All right, so H4, the daily, the weekly. I mean, of course, the monthly will show you the best correlation, but unless you guys are in for a long term and you guys don't really do sector rotations like portfolio managers do in the asset management firms or hedge funds, right? I don't think you guys will look at such long-term correlation. Okay, so depending on the mandate of the funds out there, okay, they do have to look at very long-term correlations. All right. Okay, so Chunwa, I hope that answers your question. Yes, Narisha, I will definitely show you show you guys, okay, how to find it on TradingView. Not an issue. All right. So if you guys think that's the end of the types of correlation, surprise, we have more. All right. So correlation can actually also help all of you to identify key supports and resistances as well. All right, Valeriano, what do you mean by two different major pairs? Okay, I'll wait for your explanation and then I'll go back to my slide first. All right, so on the left hand side, I have Aussie dollar. On the right hand side, I have pound dollar. Right, this is very recent. You can see the chart is really just right this week. We're right at the end of April. Okay, so why I chose these two charts? They are correlated. How are they correlated? Can anyone take a guess? How are they correlated? Aussie dollar and pound dollar. How are they correlated? What links these two FX pairs together? Okay, so yes, basic, you guys got it. Okay, positive. I wouldn't say okay, for those of you who are saying positively correlated, yes, you're correct. They are positively correlated, but they are correlated because of the dollar factor. Okay. All right, they are correlated because of the dollar factor, right? Both of them are based on the US dollar, right? So US dollar, okay, makes them correlate. Okay, so back to your question, Chunwa. Okay, correlation is not very helpful for scalping. You are absolutely right. Okay, because on the lower time frame, I'll show you guys later again, right? Correlation is really off. Okay. So back to Valeriano's question. Okay, is it two major pairs from where I showed the chart earlier, right? Okay, yes, I actually show, okay, I actually purposely picked it out like that, right? To show you guys that correlation can change at a moment's notice, all right? And And it's not just because of one major pair or another pair, right? They are fairly similar. The gold is linked to the SPX because of the dollar, right? So thanks for reminding me. I actually wanted to point this out, right? There is this guy which I am not sure. Okay, give me a moment, very quick moment, right? I want to clear all my drawing. Okay, I'm gonna show you guys. Okay, yes, this guy. Okay, so this guy, John J. Murphy, right? John J. Murphy, he is so-called the father of modern day market cross assets correlation. Okay, so very interesting book. If you guys really want to take a deep dive into intermarket cross assets correlation, this guy is the one who wrote that book. Okay, but I'm not here to promote his book, right? I'm just here to help you guys understand correlation. Now, John Murphy actually has likened intermarket correlation or intermarket analysis to that of driving, right? It's for those of you who are able to drive, okay? To get from point A to point B, of course, you need to know the route. You need to know how you're going to get from point A to point B. But while you are on the road, right, the road condition changes all the time. Just like correlations conditions, as I've shown you through the examples, they swing from negative to positive and back again. So when you guys are able to grasp the concept of correlation, it's like driving with side view and rear view mirrors. Okay, side view and rear view mirrors. Okay, for the drivers, you guys will know that having your rear view mirror and side view mirror allows you to understand what is going on around you at any one time while you're driving. So you can drive, and before you change your lane, okay, you are able to check your blind spot. You are able to see what's going on behind you, and beside you, right? Trading without correlation analysis, without intermarket analysis, is akin to driving without your side view and rear view mirrors. It's not saying that it's not possible. It's just that telling you it's a lot more dangerous. Okay, it's a lot more dangerous, right? So back to the slides. Okay, back to the slides. Over here, Aussie dollar on the left, pound dollar on the right. Both looking at the same time frame, both on the daily chart. How do we identify correlation? Right? We look at the highs and the lows. Okay, so I've identified very clearly. You can tell at a glance. Okay, I didn't really make the candlesticks the same color because I want to show you guys that in line chart you can identify the highs and the lows for the resistance and the support. So Aussie dollar, right? Aussie dollar is over here at 79.66 that's the high. That's the high back in the end of February. Now, we can say that this resistance in Aussie dollar is correlated to the high of 1.4141 on the pound dollar. So these highs are correlated. Okay, these highs are correlated. Now we take one step lower, the next resistance that I have identified, okay, at the start of March, the resistance for Aussie dollar 78.19 is correlated to the same level of 139.88 on the pound dollar. What does this mean? When the Aussie dollar is approaching this near-term resistance 78.19, we can expect the pound dollar to also be approaching a similar resistance, or at least coming close, right? So you can see that the Aussie dollar, it seems to be making the move first, right? It has already tested the resistance and rejected below it. However, pound dollar has yet to test the resistance and reject. So if you're going to go long on the pound dollar, right, it will be a risky move. Why? Because the Aussie dollar has already moved first. The Aussie dollar has already rejected it. Okay, the pound has yet to reach the resistance and has yet to reject it, and it's very, very near. So to go long on a pound dollar right now will be pretty risky. Okay, so I hope this is how I'm able to help you guys to understand correlation, right? On the flip side, let's look at the support. Okay, look at the support. Okay, the support on the Aussie dollar, the last swing low back in the middle of March, okay, is 75, 78. It correlates to the same level, okay, on the pound dollar, which is at 136.88, right? But look at, okay, so the first touch was over here in the middle of March. The second touch was in the middle of April. Look at that. Aussie dollar came close and immediately reacted. All right, when Aussie dollar reacted, look what happened. Okay, the pound dollar actually tested the same level and did a very strong reaction as well. Okay, the Aussie dollar actually made a push down but failed to test the level, and then there was a strong rejection. This would have told you that the second touch, okay, the pound dollar would probably fly off the support as well. Okay, the pound dollar will fly off the support as well. Okay, and which is exactly what it did, right? So here we are using correlation to identify similar support and resistance on correlated FX pairs. This can also be applied to across assets or even within assets itself. Like you can compare the S&P to stocks like Apple, okay, or Facebook, right? That kind of things, okay? So that is what we know as intrasector asset correlation. Okay, so that's something that is something that the fund managers also use. They actually do have some fancy tool called the relative rotation graph. If some of you are interested to find out more about it. Okay, so this is how we use correlation to support to identify support and resistance. So Suchindra, you're having some questions. Would there be a delay in correlation replication? Say Aussie dollar reverses on Monday and pound dollar catches out on Wednesday in the same week. Yes, absolutely. This can happen. It has happened. I'm not saying that it happens 100% of the time. It only happens 100% of the time if the pairs are positively perfectly correlated or negatively perfectly correlated. All right. So that's in theory, right? In a perfect world, but we know that markets are never perfect. Okay, if it's perfect, there will be no way that we can earn a profit from it. So because it's never perfect, right? It just provides, okay, inkling, right? It's just a guide. Again, go back to the analogy of driving with your rear view and your side view mirrors. Okay, so Paresh, you're asking, is the pound dollar lagging the Aussie dollar by a few days? No, they are not, right? They are not. But they could be lagging, okay? They could be lagging in terms of the market movement, right? This makes absolute sense because why? The Aussie session happens first. And then after that, the London session kicks in, correct? So by that sense, by that logical sense, we should see more movements in the Aussie pair first, in the Aussie dollar first, as compared to the movement in the pound dollar pair, right? Okay, so by logical convention and deduction. Okay, so I'm not saying that the Aussie dollar will always move first compared to the pound dollar, but I'm saying that right now it seems like the Aussie dollar is moving first. Okay, so the pound dollar could probably be reversing soon anyway if you guys were to zoom in onto the lower time frame. Okay, so Hopet, you're also asking what's the probability of this being right. Like I said, okay, correlation is never perfectly positive. It's never it's never perfectly positively correlated or perfectly negatively correlated. Okay, so the probability of this is never 100%. Nothing with the markets is 100%. Okay, the only 100% is that the markets will do what the markets want to do, and ultimately it is down to your risk management when it comes to trading. Back to the analogy, okay, you can still travel from point A to point B without looking at correlation. That is fine, but having your rear view mirror, side view mirror helps. Okay, your correlation is not going to tell you, okay, in 50 meters turn right, the kind of thing. Okay, correlation doesn't tell you to do that. Okay, correlation just tells you, hey, there's a car coming up on the left, right? Just got to be careful. That's about it. Okay, it doesn't mean that you're going to crash into a car. It doesn't mean the car is going to cut into your lane, all right, or you're going to cut into the car's lane. It's just a warning, okay, and it's just an additional good to know. All right, I hope that answers your question. So now the interesting thing is not just about using correlation to identify support and resistance. Okay, another thing that correlation can be used is to identify breakouts. Right, so this will be a bit more interesting. Okay, so on the left hand side, I have gold against the US dollar. Look at it. This is on a 1 hour, right? This is on a 1 hour, yeah. Okay, and then I have silver XAG USD on the right hand side. Okay, if you guys can't see, right, I will try to, sorry, let me just erase all drawings. Choose pen color green. Can you guys see the white line? I hope you guys can see the white line. Okay, if you guys can, then I will not draw over it. Okay, so Pei Huan, you're asking if trading on a lower time frame correlation, SNR will be best taken from daily or H4. Okay, if you're trading on a lower time frame, the H4 or the daily support and resistance will be a more important resistance or support for you on H1. But that doesn't mean that price is going to hold above it, right? There may be a small reaction. Again, you have to do a full analysis. All right, and trading on a lower time frame, be careful of whipsaws. It can get pretty volatile. All right, since you guys can see the white line, that will be good. Okay, so gold, I'm just going to write it here, gold and silver. So it's easier for you guys to compare, right? Look at that. Gold on the 1 hour is actually pretty choppy, right? Gold is actually pretty choppy. In an event like this, you won't know whether to buy or to sell. Yeah, you won't know whether to buy or to sell. Some of you may even say gold is within a channel. On the silver, okay, it's definitely on an uptrend, right? It's holding above the uptrend line, all right? But interestingly, okay, silver made a very strong breakout, a very, very strong breakout first, okay? Silver seemed to make a very strong breakout first, right? As compared to gold. Because gold is so choppy, you're probably, if you're just looking at gold alone, right, just following the line of thought, the train of thought, if you're looking at gold, if you're trading gold alone on the 1 hour, because gold is so choppy on the sideways, you'll probably be unclear of the direction, whether to play a bounce or to play a short over here, right? However, when you're looking at silver, silver pushes up and then there's such a strong breakout, right? That gives you greater confidence. I'm not saying it's 100%, right? It's just playing to the probability on your side. Okay, it gives you a greater confidence that, gold could go short as well. They are positively correlated, but that does not mean that they are +1 perfectly positively correlated. Okay, they are just about +0.8, okay, +0.75 correlation. Okay, so silver actually made the breakout first. Okay, if you guys are late to the game on silver, immediately think which is the next pair that is correlated, best correlated to silver, best positively correlated to silver. Let me take advantage of that. Immediately switch to gold and see whether there's a chance for that breakout. Okay, so gold actually gave you the chance for the breakout because there's a very strong support level here. And the moment it breaks a very strong support level, right, it also tanks. Okay, and then of course, look at that, they reversed as well, right, and it came all the way up. Okay, so that is something for you guys to think about. All right, there's something for you guys to think about. Okay, when so gold and silver are correlated because of USD. Yes, yes, generally that is right, but gold and silver are also seen as like safe havens, right? Because gold exists in limited quantities, right? It's precious metal. Silver is sort of like a second in line precious metal as well. Of course, there are many uses for silver also, right? Like scaring away vampires. Okay. Okay, so that is how you can actually use correlation to identify breakouts. All right, so I hope you guys are starting to see that correlation is very, very useful. All right, clear so far? Okay, if you guys are clear, no questions on identifying breakout. Hopefully, I can show you guys some examples later. Okay, so we are running a very good time. Okay, and moving on. Now, correlation can also help you identify the magnitude of the move, right? If you guys see this chart as familiar, it's because it is familiar. It is the same chart that I use when identifying support and resistance, okay, for Aussie dollar and pound dollar, right? So on the left hand side, we have Aussie dollar. On the right hand side, we have pound dollar. Okay, I identified the magnitude of the move with red for down move and green for up move. So very recently, when you see that the Aussie dollar drops, right? The Aussie dollar drops about the first drop, okay, drops about over a period of 8 days, it drops about 4.8%, right? Now, the pound dollar, okay, over the period of 7 to 8 days, similar. Oh, sorry, this is 9 days, okay? Similar, right? So you can see that the pound dollar lags the Aussie dollar by about 1 day, right? The pound dollar drops about 3.25%. So Aussie dollar drops about 4.8. Pound dollar drops about 3.3%. Okay, so pound dollar drops about nearly 1.5% less than Aussie dollar. Okay, so to confirm that, let's look at the next drop. Okay, let's look at the next drop over here. Right, the next drop, okay, which is 7 days, Aussie dollar drops about 3.6%. Okay, and for pound dollar, the next drop, also for 7 days, right? Pound dollar drops about 2.3%. Okay, so it's about 1.5% away, right? So it averages around 1.5 whenever, okay, whenever Aussie dollar and pound dollar drops. Okay, so if you start to see, okay, if you know that right now the correlation between Aussie dollar is that they're positively correlated, and whenever the Aussie dollar drops, it drops about 3 to 4%, you can do an educated guess, okay, to say that the pound dollar will drop probably by about 1.5% less than the Aussie dollar. Okay, so if you measure the move, the magnitude of the move, and you see that the pound dollar has already dropped about 1.5% less than the Aussie dollar, I don't think you guys want to short it anymore, right? Because then it means that, you know, the magnitude of the move is nearly there, right? So it does not make sense to try to short and squeeze out that little bit on the pound dollar, okay? It doesn't make sense to be profitable for that and take on a larger risk, right? The flip side is true as well. Okay, we look at the up move, the green arrow. Okay, the green arrow. On the left hand side, the Aussie dollar, okay, over a period of 11 days, right, rose about 3%. On the right hand side, same thing, about 8 days. Okay, so now you see that pound dollar, right, move, okay, made the same push up, right, in 8 days, whereas Aussie dollar made the push up in 11 days. Okay, so right now you're seeing a bit of a swing, right? The pound dollar is starting to move faster than the Aussie dollar, especially on the rebound. Okay, so the pound dollar moves by about 2.5%, Aussie dollar moves by about 3%. Again, here the pattern is quite clear, whether up or down, the Aussie dollar tends to move in a bigger magnitude than the pound dollar. So what does this mean? So now that you know that the Aussie dollar moves in a bigger magnitude, okay, very simply, if the pound dollar in a very strong impulsive move moves at 2% and Aussie dollar only shows about a 1.5% move, you can definitely buy the Aussie dollar, right? Because if the pound dollar goes up by 2%, okay, and we know that based on recent examples, Aussie dollar's magnitude move is a lot bigger than pound dollar, okay, and Aussie dollar only moves about 1.5%, okay, to the upside. It is then possible to play a further bullish push on the Aussie dollar to go to about 3%. So you can secure about 1.5% additional profits, okay, on the Aussie dollar. So again, this is playing to probability. It's not 100%, but correlation helps you to identify the magnitude of the move. All right. Okay, so Chunhua, you're asking how do I calculate the number of bars and days? Don't really understand. I will show you on TradingView. Okay, in fact, we are going to TradingView right now. Okay, I have about a good 10 minutes to show you guys. But are you guys clear on how we can identify the magnitude of the move? Again, it's all about identifying the highs and lows. As you can see, it's really the highs and lows, right? Okay, so generally, yes, most of you are clear. That is fantastic. Let's quickly go over to the charts, right? Is this the one? Yeah, okay, fantastic. Okay, so now I have the S&P here, okay? I have the S&P here. All right, and I want to look at it, whether how correlated, okay? How correlated it is to gold, for example. All I have to do on TradingView is you see this small button at the top, compare, right? There's this button at the top that says compare. You click on it, you can just type, okay, the ticker code, right? Over here, I have XAU USD. I can just take new price scale. Okay, new price scale. And what it does is it overlays. Okay, so I'll change the S&P to line chart. So S&P is now blue. Okay, and S&P is blue, gold is orange. So you can see that whether they are moving similarly or they are moving in opposite direction. So you just identify, okay, you can just draw arrows from the highs to low, right? You can see that they are now, okay, from this high over here. So you have to take at this point. Okay, so you have to take at this point. Same point, right? You identify the highs and lows. You take at the same point to somewhere over here. So you can tell that they are negatively correlated. Okay, something like that over that period of time, right? So correlation happens over a period of time, over the same distance. Okay, and if you were to take this, let's say this high over here. Okay, you take this high over here and you draw it downwards. Same thing, you take this high and you draw it downwards to here, right? And then you take the same point over here and you go to the low, right? You can tell that the angle, they are pretty positively correlated over this period. Okay, so this is how we can tell correlation. All right, any indicator to measure the magnitude? No, Edwin, there are no indicators to measure the magnitude, but I'll show you guys how to draw the box. Okay, so if you guys want, you can also do this. I'm just using gold and S&P as an example. Okay, you identify the highs and lows. So let's say over here we have the high. Okay, the magnitude, you can draw this on the left hand side. 1, 2, 3, 4, 5, 6, 7. You see there's this date and price range. Okay, you can just draw from the high. All right, and maybe you're taking a price range of 50 days, right? So it shows about 12.5%. The same date, 6 August. So you need to go to S&P on 6 August, okay, and draw to the low the same time where it ended, okay, 49.50. Okay, so there are 50 days, both 50 days. So the gold has dropped about 12.5%, 12.6%. In that period, okay, the S&P has dropped about 3.65%. So you do, okay, you continue doing that measurement, you can actually start seeing the magnitude. Okay, so Edwin, I hope that answers your question. Chunwa, I also hope that answers your question between calculating the number of bars and the days for the magnitude. Okay, I know some of you have questions, so I'm going to clear them as we go on. All right, so this is how we can use the magnitude tool. All right, it's on the left hand side. Just look for date and price range. Okay, now let's do Narisha's request of Anglo-American gold. Okay, I'm going to clear this orange chart, so I'm going to look for Anglo-American. Okay, so it's probably Anglo-American PLC, right? Okay, so we have Anglo-American PLC, and what's that? Sorry, give me a moment. I need to search that comment. Okay, sorry. Narisha. Okay, Anglo-American gold and platinum. Okay, so I will compare. I'll click this tab, compare, and then I can search for platinum. Okay, so platinum, it can be dollar denominated. All right. Normally I'll just this is in euro. I'll take platinum against the US dollar. New price scale. Okay, so you can see that they are pretty much correlated, right? You can adjust and move it together. You can tell that they are pretty much positively correlated because they are moving in the same direction, okay? And the moves are about the same. All right, so Narisha, I hope this answers your question on whether they are positively and negatively correlated. Now, I know I promised to show you guys a cheat sheet way, okay? So very quickly, I can just get rid of platinum. Let's say I have Anglo-American gold, the stock here. All I have to do is load up an indicator. I click indicator and I search correlation coefficient. So this is built into TradingView. All right. You can click correlation coefficient and they will ask you for the symbol. So all you have to do is key in the symbol. Like just now we are looking at platinum, right? So I'll just type platinum. Okay, and look for platinum against the US dollar, XPT USD. Click on it and click apply. Now it comes out, okay, as a red color block, right? And you can see that this, okay, so the scale should only go up to maximum 1 and a -1. Okay, it should not go above that. All right, so this is a bit tricky, which is why I prefer to use my eyeball to eyeball the charts, because I really don't know how TradingView calculates the correlation, but the fact that the scale can go up to 2 or -2 is already wrong, right? So correlation only goes from 1 to -1. But because the middle line, okay, I can put in the middle line and put it at 0. Okay, a black line, I put it at 0. Okay, so it's at 0. You can tell that platinum is generally way above 0 as compared, okay, to it being below 0. So sometimes the correlation switch from being very positively correlated. You can draw a resistance line touching all the tops. Okay, you can tell that, you know, the positive correlation between platinum and Anglo-American gold is very close to perfect positive correlation, right? Is at 0.93. But of course, sometimes it flips the other way and it goes down to maybe about -46. Okay, so this is a cheat sheet way, right? It's called the correlation coefficient indicator, right? You can do that. Okay, so back to our example on S&P, and okay, I will change this S&P and gold. Okay, so correlation coefficient, I'll key in gold, CUSD, right? Over here, apply. Look at that. The correlation of gold and S&P fluctuates quite often. Okay, between positive and negative correlation. Okay, as you go down the lower time frame, 4 hour, 1 hour, the fluctuation gets worse, right? Even on the 30 minutes. Okay, look at that. Okay, but if you go up to the bigger time frame, you cycle to the bigger time frame, things like the weekly, okay, it gets a lot clearer. Monthly, it gets even clearer. So for longer periods, right, it tends to be positive correlated. For shorter periods, it becomes negatively correlated, and then after positive correlation, and then negative correlation again. Okay, so gold and S&P fluctuates quite a bit, even though theoretically we are taught in schools that they are negatively correlated. Okay, so this is a cheat sheet way of using correlation coefficient indicator on TradingView. Okay, so Sean, back to your question. You have a few questions. If Aussie move first, how would I complete that trade? So let's go back to, okay, Aussie dollar. All right, let me clear this. Okay, Aussie dollar. I have Aussie dollar here. Okay, let's go to the daily. I'll change to candlesticks. And then on the right hand side, I have pound dollar. Okay, also on the daily, change to candlestick. Okay, look at that. The Aussie has already reacted, and just now earlier, compared to the graph, right, you can see that the Aussie has reacted, but the pound, the body of the candle is slightly bigger. Back to the chart, you can tell that the pound is now pulling back, right? So if the Aussie is moving first, and if I'm trading the Aussie, obviously I would not really trade the Aussie. I would prefer to trade the pound dollar instead, because the Aussie is moving first and pound dollar is lagging behind, so I will trade the pound dollar. All right. So that is how we use correlation coefficient. But even then, if I want to stubbornly trade the Aussie, okay, if I want to stubbornly trade the Aussie, then correlation will be, in a sense, out the window, right? Because if I want to be stubborn about it and trade the Aussie, there's no point for me looking at correlation. So like I said, back to the analogy, okay, correlation is really more of like driving a car with your rear view and side view mirrors. It doesn't really help you in taking the trade, okay, but it gives you warning signs, right? It helps you understand what is going on around you. Okay, Jo Chen, you're asking how do I handle the fact that correlations are changing over time? Again, back to the same analogy, you just have to take it for what it is. Understand that yes, correlation can swing from positive to negative correlation. Okay, at the end of the day, if let's say if Aussie dollar and pound dollar, we know they are positively correlated. How do I know, right? I can include that cheat correlation coefficient indicator, and I can just put pound dollar. Okay, I'll click apply. Look, on the daily, they are very strongly correlated, right? Now, if Aussie and pound dollar are very strongly correlated, okay, at the end of the day, okay, if I'm going to buy the Aussie and short pound dollar, what does this tell me? Okay, I'm playing against correlation. I will be very careful, all right? I will be very careful if the Aussie is showing a very strong uptrend and I want to short the pound, okay, the pound dollar. I will be very careful. I will go in a smaller position size to short my pound dollar, okay, because the probability of the pound dollar moving in line with the Aussie is bigger as compared to the pound pulling back. Okay, so this is how I will actually handle the fact that correlations are changing over time and how I manage my trade. Okay, we're running out of time. McWin, what do I click to show the chart side by side? On the top right hand corner, there is this next to the tab. Okay, there is this layout. You can actually select the layout. I think if you have a paid account for TradingView, then you can select all these layouts, right? If not, it's just single, but not to worry, you have the correlation coefficient indicator, and you can actually also overlay the pound dollar. Okay, or you can overlay whichever chart you want with a new price scale. Okay, something like that. All right, so I hope that answers your question. Is gold really correlated with the DXY? Okay, again, the dollar is a special one because of the dollar small theory, but let's just look at gold very quickly. Okay, so I have gold as a candlestick. Okay, let me get rid of, okay, so I can load up the DXY on the chart. Okay, and you can see sometimes they're positively correlated, sometimes they're negatively correlated. You can also confirm with a correlation coefficient, and then you just put in DXY and you apply, and you can see, wow, it seems like most of the time they are generally negatively correlated. So they are always correlated, but it's just whether positive or negatively correlated. Okay, okay, sorry, Eugene, you asked indices like HSI also have correlation. Yes, of course. A lot of Asian indices, right, actually are very correlated to the big brother, which is the S&P, the NASDAQ. So if you know how the NASDAQ and the S&P move overnight, there is a high chance that you just blindly follow. Okay, I'm saying this based on my experience because I really started out analyzing indices in the first place for the institutions, right? So you can just blindly follow what the S&P did overnight or the NASDAQ did overnight, and you'll probably see the same move, right? Whether same magnitude or not, you have to go and do that correlation study yourself, but you'll generally see the same directional move on the Asian indices. Okay, but please go back test yourself. So having said that, I hope that answers your question.